Step 5. Preparing adjusting entries. Now, for the non-cash, it involves depreciation. Depreciation is applied to components of PPE or fixed asset except land. This is done to allocate the cost of a fixed asset. Now, the common entry and the entry will always be debit depreciation expense and then credit accumulated depreciation. Then just indicate what type of fixed asset is that. Main types of depreciation methods, we have 4 types of depreciation such as straight line method, units of production, double declining, then sum of years. Now, I don't want to bombard you with this 4 types of depreciation method because I'll be discussing the only one, straight line method. And that's it. Straight line method has this formula. Annual depreciation is equivalent to or is equal to cost minus the salvage value or scrap value divided by the estimated useful life. So under this, cost is the original amount of the fixed asset. Salvage value or scrap value is the value expected from disposal of a fixed asset after its useful life. When you sell it, I mean. Estimated useful life is the expected useful life or the lifespan. This information must be given in order to compute for the depreciation. For example, we have January 1, 2020 purchase an equipment on account 22,000 pesos. Then the details, the equipment has a useful life of 5 years and a scrap value of 2,000. Now, we are to prepare the adjusting entry. And then the adjusting entry on December 31, it's a 1-year period. January 1 up to December 31, it's a 1-year period. So entry is depreciation expense equipment because equipment was used, then accumulated depreciation equipment. Then the amount is 4,000. How did we come up with 4,000? Now, using the formula, cost is 22,000, salvage value is 2,000, subtracting the 20,000 divided by 5, estimated useful life. So we have 4,000 annual depreciation. And as you can see, it's January 1 to December 31, so it is 1 year. So we will use 4,000. Now, other examples. May 31, a machinery was bought on notes, 50,000. Then the useful life is 5 years, scrap value is 5,000. Now, if we are to prepare the adjusting entry of December 31, 2020, now it will go like this. Depreciation expense machinery, debit, and then credit accumulated depreciation machinery. Now, the amount is 5,250. How did we come up with that? Just use the formula, but please be careful with the dates present in the transaction. This is from May 31 up to December 31. If it is from May 31, meaning to say we will start counting with June, July, August, September, October, November, December. So it just involves 7 months and not a 1-year period. So please look for the monthly depreciation. 50,000 minus 5,000 scrap value, 45,000 divided by 5 is 9,000 pesos annual depreciation, good for 1 year. However, we will not use 9,000 because we only have 7 months. We will use this formula. So 9,000 times 7 months, the number of months present, then divided by 12 because we have 12 months in 1 year. So we get 5,250 pesos. This is a 7-month depreciation. Or you can do this, 9,000 annual depreciation divided by 12 to compute for the monthly depreciation. So 750 monthly times 7 months involved. So 5,250. Either of the two. Note, depreciation only applies to fixed asset except land. So it involves building equipment, furniture, machinery, other PPE, transportation, buses, and whatsoever. So let's now try to prepare adjusting entries in the previous example related in the previous video lesson. So this is the JM Consultancy Services transactions last time. Now what I'll add here is the additional details of the equipment as well as the number of supplies at the end of January 31. Then the task is to prepare the adjusting entries on January 31. Let's start first with letter A, the equipment. So I just stated here, you can use asset method, liability, or straight line depreciation if applicable. So of course, the letter A involves depreciation because it is a fixed asset. So the adjusting entry in letter A, we have depreciation expense equipment, then accumulated depreciation equipment. For the computation, we will have 17,000 the cost minus 26 scrap value divided by 4, we have 36. This is the annual depreciation. Now, if this is the annual depreciation, multiply it by how many months? We have 1 month because January 1 up to January 31, we only involve 1 month. And we can just roughly estimate, January 4 to January 31 is almost 1 month. So we'll use 1 month depreciation. So times 1 divided by 12. So we have 300. 300 pesos, 300 pesos. For supplies on letter B, supplies on hand amounts to 3,720 from the original amount 5,000 pesos. So this is the simplest adjusting entry. Just subtract the two to get the amount of supplies that were used. So 5,000 minus 3,720 remaining. So we have used up 1,280. That's why we will use supplies expense because it is a portion of supplies that were used, 1,280, and we have to credit supplies since supplies is a debit, has a debit normal balance. If it increase, debit supplies. If it decrease, credit supplies. So that is the adjusting entries. Now I have here a computation if you are more specific with the number of days for the depreciation, but technically we're just using approximate number of days.